want to say good morning, and my name is Tom Vukovich with Insurance Network America. I'd like to welcome everyone and thank you for joining us today for our call on life insurance concepts and strategies proven to close more sales. As you all may be aware, September is Life Insurance Awareness Month, and today's topic is in line with that theme. We realize that you're taking time out of your busy schedules to join us. We certainly understand that and take that to heart. So it's always our intent on these calls to provide you with impactful and useful content that you can immediately apply to your practice. I'm extremely excited today to introduce our speaker, Kyle Veenstra with Global Atlantic. Kyle is a senior field trainer with Global Atlantic. He's fantastic and passionate at what he does. Prior to his current role, Kyle was a regional wholesaler covering 8 states in the Midwest. A couple of things about Global Atlantic. Currently, they are the fastest growing company in the industry, and they have some extremely competitive solutions that you really need to take a look at for your clients. For those of you on the call that have not yet contracted with us and Global Atlantic, I would strongly encourage you to get contracted with INA and give us the opportunity to earn your business. We have a lot of impactful information to cover today, so I'm not going to waste any more time. I'll get the presentation over to our speaker. If you have questions during the call, please submit them to the GoToWebinar menu, and we will do our best to answer all of your questions at the end of the presentation. If you have a client in mind, you want to talk about an illustration, don't hesitate. Give us a call. Our number is 800-456-7999. So then at this point, I'd like to welcome and introduce our guest speaker, Kyle Veenstra with Global Atlantic.
Thank you so much, Tom. I appreciate the warm introduction and the opportunity to speak with your folks about our newest product that we added to our product portfolio. Obviously, the core of this conversation, this call, is about positioning our death benefit focused product, Lifetime Foundation Elite. I did want to mention before we got started, though, that Global Atlantic has a variety of product solutions. Lifetime Foundation Elite is our death benefit focused product, and we're going to really dive into sales concepts and strategies using this product to provide a client solution. But don't hesitate to contact your INA representative about our other products as well. Specifically, our Survivorship Builder. We have a super competitive Second to Die product. It's perfect for legacy and estate planning, business succession, a really unique opportunity with Survivorship Builder to take advantage of that competitive cost structure that they have, both either for cash accumulation or maintaining a death benefit for those legacy and estate planning needs. A lot of business applications, business owners using that product. So take a look at Survivorship Builder, as well as we introduced a top tier cash accumulating IUL product, Lifetime Builder Elite. And this is designed to increase cash value so your clients can take out supplemental retirement income streams. Super consumer friendly features that we've added to it, as well as top tier accumulation potential with that product, and a variety of other solutions too for your other clients in terms of some things that you can look at. But I did want to highlight those 2 products along with the deep dive that we're going to do on Lifetime Foundation Elite. Now, the story with Lifetime Foundation Elite is a couple months ago, we noticed there was a void in our product portfolio, in particular, a dynamic death benefit focused product. At Global Atlantic, we've had a lot of success in the cash accumulation IUL space, along with our top tier Survivorship Builder contract. A lot of successful agents using those products, but we really found that there was a gap in kind of that protection focused product that we had. So our product team put together a compelling solution called Lifetime Foundation Elite. And really the genesis of kind of that protection focused product was a simple and concise message that we can market to the agents, who in turn market to their clients. And really it boils down to 3 important terms. And the first is simple. Lifetime Foundation Elite provides opportunity across all products of protection-focused products offering a simple death benefit guarantee that's to the earlier of age 90 or 40 years. That's what the initial guarantee covers. Along with that simple death benefit is an affordable premium that competes across many ages, okay? We want that simple guarantee to be encompassed with this product, but an affordable premium that makes sense for your clients. And the last key component of that is security. A secure design that not only allows the policy to run to life expectancy, but gives it the opportunity to carry to age 121, even at relatively low illustrated rates. So simple, affordable, secure, that's the messaging market around Lifetime Foundation Elite. The guarantees are based off of what risk class that your client comes back at. So if you do have a premier, preferred, or standard risk class, you're going to be looking at that guarantee period extending out to age 90 or 40, whichever one comes first. If you have some clients that are tobacco rated, that guarantee drops down to 30 years or age 80. And if you have table rated clients on a non-tobacco basis, that will take them to age 80 or 30 years. And if they're table rated tobacco, age 70 or 20 years, whichever is earlier. So really that key segment of the population that we're looking at, particularly with that guarantee, is those clients that are premier, preferred, standard, but we still have a solution provided that if they're a tobacco user or come back table rated. So that's how the guarantee works. That guarantee is built on an index universal life chassis, okay? So the client's premiums will be going into selected crediting strategies, but really the focus on this product is the premium that you need to get that policy to run to age 90 and the ability for that policy to last beyond age 90. And how you do that is an affordable premium. And Global Atlantic deliberately positioned Lifetime Foundation Elite to really be competitive in the 50 to 70-year-old range. Not that you can't write this product on a 40-year-old, still pretty competitive there, but most of the time, when someone's looking for a permanent death benefit focused product, they're usually falling between the ages of 50 to 70. And we deliberately made those cells also competitive with Lifetime Foundation Elite, both male and female, whether you want to pay for life, single pay, short pays, if you want to 1035 money into the contract and reduce premiums on a current policy that the client's paying. A lot of flexibility, a lot of options, but the key to that is that affordable premium. I think once you see the numbers, which I'll show you here in just a second, it's safe to assume that those affordable premiums really provide that great solution for your clients looking for death benefit focused protection. And the last key component of that is a secure design. With Lifetime Foundation Elite, we're seeing an influx of, some refer to them as hybrid products, bridge products, life expectancy products. We're seeing a lot of companies in terms of guarantees, really looking at those types of products to provide a competitive solution, but maybe they don't want to offer that complete, full, no-lapse guarantee. We want to take a different spin on that. And really what we're doing here is we're solving a mortality curve drag. We're establishing a policy charge structure to collect coverage costs sooner rather than later. So you will see with this product, the client's cash value will be a little bit lower in the early years because we're taking the charges a little bit higher up front. But what that allows us to do is to stop charges at age 90 other than a policy fee, okay? A lot of problems that people run into with these bridge hybrid products is, if you think about it from a life expectancy perspective, there's a good chance that a chunk of your clients will live beyond that life expectancy, right? That mortality expectation. So what Lifetime Foundation Elite actually does at age 90, mortality charges end on a current non-guaranteed basis. But remember, we're accepting those charges up front to provide that benefit, okay? And what that does is it protects your client from that longevity risk. And that's huge. It makes sure that when you're positioning this product and you're promoting this product as a solution for your client, we're hoping that they live longer than 90, right? And if they do, They have the options to not have to worry about continuing paying a premium, right? Or having enough cash value to offset those extremely high mortality and expense charges well into their 90s. That's eliminated with this provision in the contract, okay? So if you think about that with this product, an IUL with a built-in guarantee, and then at age 90 those charges go away, you really only need nominal amounts of account value in those later years to make sure that policy runs. And that's really where that competitive nature of the premium that you need to get this to run, that's really where that all comes together. And we deliberately here, obviously we can talk, I could sit here for an hour and talk about the product, but I wanted to get the key components of kind of how that product works. If you want a little bit more in-depth details, we'll get resources over to your INA representative, and they can get that information over to you. But mainly I want you to get the idea of kind of how the product works, right? It's an IUL product with a built-in guarantee, and at age 90, those mortality expense charges go away. All there is a small monthly fee of $6 a month or $72 a year. When you see illustrations on this product, a lot of time we put about $5,000 of cash value at age 90. Again, that's probably plenty enough to get that to run the entire way. That's just a simple calculation that we do to give you a little bit more wiggle room. But in theory, all you need is $1 at age 90 and you're fine. So let's talk a little bit about positioning on this product, right? When you're out there talking to clients and you identify a death benefit need, clearly you have a couple different options that you can pivot to in terms of kind of what you want to do with that. And a lot of that depends on what the client can afford, what their goals are, and kind of how they see life insurance in their overall portfolio of protection, right? And one thing I wanted to kind of, the first thing I want to compare Lifetime Foundation Elite to would be term coverage, right? A lot of times that you're talking to clients, term's an easy solution, right? It's simple to explain. The cost is significantly less than a permanent plan, but there's some downfalls, right? Cost-conscious life insurance shoppers tend to move towards term just because it's a cheap solution. But what are the issues with that? Well, once that initial term period expires, we know that those term premiums can increase significantly, right? You're basically at that point on a renewable term basis, or there might be a significant need and the client needs a new policy, right? And now that you're paying those premiums based on that new, older attained age, as well as their current health, right? They may not, you may talk to a 30-year-old, get a 30-year term at age 60, their health is going to have changed significantly. They may not even qualify for the insurance anymore. Another issue that comes up with term is, right, that lack of flexibility. There's no cash value there to adapt to changing needs. Basically, if you can't pay that premium, you don't have a lot of flexibility, right? And as we all know, that death benefit of term products goes away once that term period is complete. Another thing to consider with that is, with that term coverage is, we know the stats around it, right? Unless something happens prematurely, basically an accident, most of the time a term policy isn't going to pay out. I think that the national average is somewhere between 3 and 5% of term contracts that are issued that actually pay out a death benefit. So there is short-term thinking with that, but we also have to be realistic on, from a protection-based, how much is that term going to protect the client when they need it the most? So let's look if we compared term insurance over a long period of time to Lifetime Foundation Elite. So on that top board, we have our term. So 30-year-old, we're going to initially get them in a 30-year term. So it's going to take them to age 60. Annual premium, just under $500 a year, right? And that's going to protect them all the way to age 60. Total premiums put into that contract would be about $14,000, and we know there's no cash value in there. We identified these numbers are based off a $500,000 death benefit need. So what happens to the client at age 60, right? Their term expires, and they got to make some choices. Well, for this client situation, they still need coverage, right? And they don't want to pay on a yearly renewable basis. So they're going to get back into another term contract for 20 years to take them to age 80. Well, where did that premium go? It jumped up to $4,500 a year. Okay. If we look over that 20-year term duration, they'd put about $90,000 into that term plan. So overall, from age 30 to age 80, between those two policies, they put over just over $100,000 of premium into the policy. And oh, by the way, if they're still living at age 80, they don't have term coverage beyond that, right? Or they're going to have to pay a significantly higher term period to keep that $500,000 of protection in place. So what if they would have purchased a Lifetime Foundation Elite up front, starting at age 30? Well, their annual premium would have been $1,700, which is significantly higher than initial term period, but paying that premium to age 80, the total premiums paid into the policy would have been $85,000. So almost a $20,000 difference in total premiums paid into the policy. And oh, by the way, they still have coverage, right? They still have cash value in that contract. At age 80, they have over $100,000 of cash value. So they could continue paying that premium, or maybe they let the cash value of the policy fund that remaining death benefit. We know that all they need to do is have $1 of cash value at age 90. So maybe they let the cash value run that policy. So they've saved total premium once they get to age 80, not to mention they have some flexibility and some options beyond those later years. Now they have the ability to pass that $500,000 death benefit onto their beneficiaries where they didn't have that option using the term coverage option. So that's where we talk about the price of short-term thinking. And obviously, as an insurance agent, when you're talking with clients, you know, maybe they aren't able to pay that $1,700 premium, but some clients might. And if you show them that long-term strategy and kind of how that term performs and acts and the different things they'll have to do, it might make sense for them to pay a little bit more premium up front to have some additional flexibility down the road and potentially have that coverage last. I did this same exercise with a $1 million death benefit. We're not going to go through the whole thing because really the numbers kind of just played themselves out the same. And the reason I did that was I just wanted to show you that it wasn't kind of just a niche death benefit that I used, that this concept only worked at $500,000 or smaller face amounts. It works both with smaller and bigger face amounts, right? That story is still consistent where if you show the client the difference between a short-term thinking solution with term compared to a long-term solution with Lifetime Foundation Elite, it might sell itself pretty easily, assuming that the client lives beyond age 80, which, again, unless you're looking at an accident or a serious health situation that comes up, most healthy clients of yours have a good shot of getting into their 80s relatively easily, and that's not even considering the advances that we make in healthcare and things, that life expectancy continues to increase. So from a planning perspective, particularly with a young fellow in his 30s, it might make sense for you to have that conversation about a long-term approach as opposed to just let's do a term policy and cover that need today. So the next thing I want to talk about positioning is single pay and short pay scenarios. So how do we leverage Lifetime Foundation Elite when you have a client that's willing to pay a little bit more premium up front, they're a little bit more liquid, have a death benefit need, they want estate planning, legacy planning. There's really thinking about that long-term situation where they want to pass a tax-free death benefit onto their clients. How can we establish that? How can we do that? And I want to show from a competitive standpoint what that looks like. From a from a single pay perspective, we have a client, male 65 in good health, standard, looking for $1 million of death benefit protection. Now in this scenario, he's looking to do a single pay, okay? One premium payment, that's it, have that death benefit for life. Now, one of the advantages to using Lifetime Foundation Elite is when you're willing to pay a little bit more premium up front, you get major benefits back. Here we benchmarked Lifetime Foundation Elite against some of the best no-lapse guarantee solutions in the industry today, okay? So we took that $1 million death benefit for that 65-year-old. What do you need to put into a no-lapse guarantee policy to get that policy guaranteed for life, pay one premium, okay? So most of those policies are just, from a pricing standpoint, almost about half of what the death benefit would cost, right? You got Pac Life at $460, American General at $490, There's other carriers out there that get closer to about $500,000. So in exchange for $500,000 of premium up front, the client basically locks in $1 million death benefit once they pass away to their families. Well, if you run that same scenario with Lifetime Foundation Elite, we can give that a significant premium reduction, right? Instead of paying that $460 or that $480, the premium reduces to about $330,000, right? The guarantee takes them to age 90. They still have significant cash value to age 90, and the policy continues to run for them, okay? That's the value prop that Lifetime Foundation Elite provides. It's going to be a cheaper solution than those no-lapse guarantee products because, in theory, we're guaranteeing it to age 90, but with that additional provision in there that the expenses and everything goes away except that nominal monthly fee, we're able to provide that death benefit protection at a significant reduced cost than those no-lapse guarantee carriers. And that plays itself out in the single-pay scenario. You might be saying to me, well, that's great, Kyle. I don't know a lot of clients that can pay all that premium at once, regardless of what that death benefit needs is. Well, maybe you have clients that want to pay 7 years of premiums, 10 years of premiums, 15 years of premiums, and get that paid up. Well, those what we call short pays, those are still really competitive too with Lifetime Foundation Elite. Took a little bit younger client, a 55-year-old male, a little bit smaller death benefit, $500,000 in coverage, and ran the same competitive scenario, right? So we're showing basically from a no-lapse guarantee perspective, if your client wanted to pay 10 equal premiums into the policy and have that policy paid up, what would that premium look like? So again, some of the competitors came back at $13,200, and they moved down and get closer to about $15,000 in premium. Well, if we run that same scenario in Lifetime Foundation Elite, we can accomplish that same protection goal for significantly less premium, just over $11,000 of premium, right? Again, that's going to carry them out to age 90 on a guaranteed basis and have plenty of cash value to have that run to age 121. So really what I want you to take from this is how competitive this solution is for your clients that are looking for opportunities for protection, and maybe they want to put a little bit more premium into the policy, get it paid up early. This is a great vessel for them to do that. Also, another thing to consider too is I've had a lot of agents have success with 1035 money into this policy, right? Maybe they have a whole life contract that they're paying premiums into, and they're tired of paying those premiums. They want to leverage that cash value in a 1035 and potentially stop paying premiums or drop their premiums significantly. Lifetime Foundation Elite provides that solution. Easily can accept 1035 money into it, and you could potentially, for that same death benefit, have them stop paying premiums or reduce their premiums. So I've seen a lot of agents having success with taking a policy that's either underperforming or maybe the situation changed. They wrote, again, a lot of them I see is a whole life policy that was wrote, 10, 15 years ago on the premium. They're just tired of paying that premium or don't want to pay that significantly high premium. Maybe they have an opportunity to put this into Lifetime Foundation Elite from that cash value and reduce their premiums altogether or significantly reduce them to make it a little bit more affordable for the client, but still give them the death benefit protection that they earn. So we benchmarked Lifetime Foundation Elite against some no-lapse guarantee solutions in kind of short pays and single pay situations. Well, what about if you have a client, right, that needs death benefit protection, but they're willing to pay continuous premiums through the life of the policy? One concept that we came up with is called Their Premium R product. And kind of what that does is compare the benefits to using Lifetime Foundation Elite to kind of what I'll call a traditional no-lapse guarantee type situation. So let's first talk about those two different product types, right? From a guaranteed death benefit perspective, no-lapse guarantees, most of them follow a shadow account approach, right? You're basically paying permanent term, right? Not a lot of cash value, not a lot of premium flexibility, and if that client can't pay that premium, not a lot of options, right? No catch-up provisions in there. Well, when we compare the benefits of Lifetime Foundation Elite, we don't use a shadow account approach. We use a cumulative premium test. And what that allows the client to do is it gives them the ability to catch up the death benefit guarantee. So I'll give you an example. Let's say the minimum premium for whatever death benefit that you select is $1,000 a year, okay? And Your client's paying the $1,000 a year. Get to year 10, they can't make that premium payment, okay? What happens with a no-lapse guarantee solution? They're probably going to lose the policy altogether, or at a minimum, their guarantee is going to be significantly reduced because they didn't pay that $1,000 premium on time. With Lifetime Foundation Elite, they have the ability to catch that premium up, that $1,000 that they missed at any time, okay, without an interest charge being added to that. They can catch that $1,000 up at any time. But remember, too, there's another ability in there to keep that death benefit going. As long as there's positive cash value in the contract, they technically still have death benefits. So if the client misses that premium payment, but they still have plenty of cash value once they get to age 90, there's no effect on them, right? So from a guaranteed death benefit perspective, Lifetime Foundation Elite provides a pretty competitive solution that some of the things that MLG contracts unfortunately can't do. What about premium flexibility? I did talk about a little bit with the last slide, but no lapse guarantee, it's simple, right? You pay that illustrated premium, you don't have that flexibility. We've even seen situations with no lapse guarantee, they're so time sensitive, if your client pays premiums ahead of schedule, they can actually lose their guarantee. That's how time sensitive those premium payments are. You don't run into that with Lifetime Foundation Elite. Early payments just equals better cash value accumulation for the client. And by paying more premium, calling it overfunding it, it gives them greater flexibility. We showed you that, right? In those 10-pay and those single-pay scenarios, the premium is going to be cheaper when you compare it to no lapse guarantee, but if we get premiums early, it just gives the client more flexibility down the road. So on a day-to-day basis, you know, when you're setting up a death benefit protection focused product, the fact that Lifetime Foundation Elite kind of has that flexibility, it gives you an upper advantage compared to those no lapse guarantee things, because you're not having that tough conversation with the client. I can't pay that premium this year. No lapse guarantee, you don't have a lot of options. Lifetime Foundation Elite, we can look at the cash value. If there's enough to support it, maybe we don't have to make that premium payment up. Or if it is getting close, it doesn't mean they're going to automatically lose the guarantee. Say, hey, maybe we can catch that premium up in a couple of years, no sweat. Just makes that conversation and the interaction with the client a lot easier. So let's benchmark this again, okay? So 55-year-old male, pretty good health, $500,000 of death benefit. Now we're looking at they want to pay the premium for life, okay? So our premium, depending on the company that you decide to use, is looking between $6,200 and $6,700. Well, with Lifetime Foundation Elite, our minimum premium is going to be significantly less. Usually you'll see at a minimum about a 10 to 12% premium, we look at the two. The best no lapse guarantee solution in that cell, usually Lifetime Foundation Elite is going to be about 10 to 15% cheaper. And you know, as you go down the list, that gap even widens where it's pretty common for us to see that the premium is actually 20 to 25% less than that no lapse guarantee solution. But as the concept is called, their premium our product, what if we put that same premium that if the client's willing to pay that what would be a no lapse guarantee solution, what if we put that same premium into the Lifetime Foundation Elite? What would be the minimum interest that I would need to make sure I had positive cash value at age 90, okay? So based off our minimum premium and a 6% rate of return, $5,400 will accomplish that. But if my client's willing to match what that would be put into a Symetra policy, $6,200, now they don't need 6%. Now they have positive cash value at age 90 by earning a significantly less interest rate of 3.9%, okay? And if your client's willing to pay $6,700, all they need to earn is 2.4%. Folks, remember, with Lifetime Foundation Elite, our minimum interest rate that they earn is 2% compounded annually, okay? So worst case scenario, the minimum guarantee is 2%. If you're willing to fund that policy with $6,700, just like the no lapse guarantee solution on the bottom of the opportunity, you basically have to earn 40 basis points over the guarantee to make sure you have positive cash value at age 90. So that's what I'm talking about, that overfunding gives you greater flexibility, right? We fully expect the client to earn well over 6% during the life of the contract, but from a safety and a conservative perspective, if you're willing to pay slightly more premium, you don't have to earn close to 6% to get positive cash value at age 90. Oh, by the way, another opportunity, leverage Global Atlantic's increased participation strategy. We actually have a strategy that doubles your index credit guaranteed. It's a 200% participation rate as opposed to a 1%, 100% participation rate. So for a slightly lower cap, you get a doubling effect on your index credits. So if I think about that, if I'm willing to pay that $6,200 premium matching what Symetra would provide, I only have to, if I put my money, segment the client's money in the increased participation strategy, I barely have to earn 2%, the minimum guarantee, because it's going to double those credits, right, to get that policy to run. So that concept basically shows two different things, right? If you pay more premium than the minimum premium that Global Atlantic illustrates that, if you pay a little bit more premium, that just means that the client has to earn even less interest to get positive cash value at age 90. And if you leverage our increased participation strategy, you get a doubling effect that makes those strategies necessary to get the policy to run out even less. Again, if you have any questions on that, reach out to your INA representative and they can show you an illustration using both Lifetime Foundation Elite and the increased participation strategy. The last thing I'm going to talk about in terms of conceptually is wellness for life impact, okay? Wellness for life is a rider option with Global Atlantic that's really unmatched in the industry. And how this actually works is if your client elects to have wellness for life on their policy, they have the ability to reduce their cost of insurance and in turn reduce the premium necessary to carry death benefit coverage out, okay? So let me tell you this quickly how this works. So if the client's willing to select wellness for life on their policy, Global Atlantic takes $100 of cash value up front in the first year, and that's the only cost. And notice what I said there. It's not $100 of premium. It's $100 out of the account value in year one with no additional cost after that. And what that rider allows them to do is that they do basically wellness checks. If they go get a physical every 2 years, they're able to realize wellness for life rewards that will impact premiums necessary to guarantee the policy out, okay? So there's a form that we send out that basically you take to your doctor, you sign it and say, hey, I visited the doctor. That's all it asks. We're not asking if anything has changed in their health. We're not re-underwriting the policy. Basically, all we want them to do is go to the doctor every 2 years, okay? And they get a level of rewards, cost of insurance reduction off their policy. Well, there's a second level of rewards too. If they stay within a reasonable weight range that we have established at policy issue, they're able for a second level of rewards, okay? So they go to the doctor every 2 years, doctor weighs them, they put that on their sheet. If they're within that weight range, they get 2 levels of wellness rewards, okay? And how that impacts the policy is we actually take those rewards, those cost of insurance reductions, and we multiply them times policy year in force. So a real quick math here, if going to the doctor is worth 0.5% and staying within that weight range is another 0.5%, that's a 1% reduction in their cost of insurance. But remember, we're going to multiply that times policy year in force. So if they're in their 20th year and they go to the doctor and they stay within that weight range, they're going to get a 20% reduction on their cost of insurance charges, okay? We've had this program for almost 10 years. There's active policyholders in our book of business that are getting a 10% reduction on their cost of insurance this year, okay? So let me put some numbers around it. Let me kind of show you how that would all work out, okay? So right here we have a gentleman, male, non-tobacco, 57, and he actually came back at table 4, okay? He needed $500,000 of coverage. So the minimum amount of premium to carry that $500,000 of coverage is $11,700 a year, okay? That'd be his minimum that you have to pay every year to keep that guarantee out to age 90. Well, you see a curve there, right? And this is the wellness adjusted premiums. So this is taking, assuming that they're going and they're taking advantage of the program, it's showing that the premiums continue that significantly go down as the policy gets older. Client gets older and the policy matures and stays in force longer. So fast forward, that guy's 57 years old. Fast forward to age 86. Based off those Wellness for Life rewards and adjusting his premium, instead of owing a $11,700 premium, that premium's been reduced to $7,800. Okay, and basically that means if that client would have came back as a standard risk class back when he first started the policy at age 57, his premium would have been $7,800. Now we know that he came back at table 4, so the minimum premium was $11,700, but because he's getting those Wellness for Life rewards, when that client's 86 years old, his premium's reduced to $7,800 what he owes. Remember, what did he pay up front? $100 off his account value in the first year, that's it. Is that a pretty good deal for that client? Absolutely. And we see fast forward that even further, at age 88, his premium is reduced to $6,500, and that would have been the same premium if he would have been a preferred risk class at age 57. What I want you to take from this is that the discounts are significant and the premium reductions are significant and can have a huge impact on what your client actually owes to keep that policy in force. So that's a marketing piece that we use, but within the illustration software, if you're in a state that wellness is available in, it will actually show you two different things, both a graphical image of what that looks like. So on the left-hand side, that's showing the client's premium staying consistent, that blue line, right? But if this client takes advantage of those Wellness for Life rewards, that premium curve starts to match that net premium, that green line going down, right? And you can see how significant that those premium savings could be for the client. If they're not visual, if they're more numbers people, the supplemental report for Wellness for Life also provides an actual premium outlay in the form of numbers it will show. So it will show you what the reduction is each year and what the client would actually owe to keep that policy in force. And again, you'll see that the premiums are pretty significant. And what a unique way to market yourself, right? Imagine that phone call when you call your client and say, hey, you know, it's that time of year, Mr. Client. We got to get that form filled out so we can reduce your premium, okay? Doesn't happen very often where your insurance agent calls you and say, hey, pay me less premium, right? Usually you're having the opposite conversation saying, hey, we don't have enough cash value in the policy. We need a little bit more premium, right? It's the reverse situation here. And I'll tell you one thing, you're probably going to get more opportunities to have policy reviews and get clients back in front of you about reducing their premiums, right? And it's a great opportunity for you to talk about different products, ask for referrals. Anytime that you're in front of a client, it's an opportunity to make money or build a new connection, right? And this rider, in conjunction with Lifetime Foundation Elite, really provides you that opportunity. So it looks like we're about at time. I was trying to keep it under about 35 minutes. So I'm going to turn it back over to Tom. And just real quick, I'll say for everyone on the call today, I really appreciate the opportunity to talk to you about Lifetime Foundation Elite and solutions with Global Atlantic. If there's anything that we can do to help you out, let us know. We have a great relationship with INA, and we're happy to partner with them. So with that, I'm going to turn it back over to Tom, and hopefully we have some time for some questions if that works for him.
Great. Hey, Kyle, thank you. Excellent job. A couple quick questions on what you were just talking about. A question came up. Can you send in the additional premium? And I believe that's referring to
the wellness. Yeah, you could pay more premium, or you have the option to take that reduction in premium, or you could continue paying the same plan premium, and basically that would just equal more cash value in the policy. You have that flexibility, absolutely.
Okay, great. Thank you. And then earlier on, there was a question when you were showing the comparison of the cost versus term. The question came up of how does the cash value compare for use as a supplemental retirement plan?
So are you saying if you would take the difference and put that in there, or if you were able to access the cash with Lifetime Foundation Elite? What's your take? What do you think they're asking there, Tom?
Yeah, we can follow up individually as well, but I think you were showing the comparison of the different term prices, and how that compares to other companies. How does this compare to cash value? And I think along the lines of Lifetime Foundation Elite is more death benefit focused. Would you look at this for that type of a vehicle, or would you look at one of your other solutions?
I would say if cash value accumulation is the key focus, right, and supplementing supplementing retirement with tax favored distributions, I would point them to Lifetime Builder Elite. This does gain, it does accumulate cash value decently, but really the way I look at that is with Lifetime Foundation Elite, I think of those cash accumulating those credits as the ability to give the client flexibility down the road. My point being, if your client gets to age 85 and you have $150,000 of cash value in there, to me, I'm going to tell my client to stop paying their premium, say, hey, we have plenty of cash value to support the death benefit and get us to age 90. So there would be some potential opportunities where you could take we still have all of our loan features. You can still access the loans, the cash value the same way you do with our Lifetime Builder Elite cash accumulation product. But, I think you probably have to have that honest conversation with the client and say, what's most important here? Does it make, if we're paying that same premium, and maybe that's what you do. Maybe you have INA run you a couple scenarios saying, hey, my client can afford this. What's my cash value look like with Lifetime Builder Elite compared to how much death benefit can I get for that same premium with Lifetime Foundation Elite, and kind of make that decision there. But kind of the rule of thumb, if cash is king and they're going to access cash, I'd put them in Lifetime Builder Elite. I think you'll be really excited about how that policy performs. If you think death benefits and guarantees and affordable premium in a permanent plan's more the client's focus, Lifetime Foundation Elite's where I'd push them.
Excellent. Thank you. Okay, that for now is all the questions I have up there. Again, I want to thank everyone on the call that joined us today. And special thanks to our active producers that are on the call. Thank you for your ongoing commitment and partnership. If you are not yet contracted with Insurance Network America or Global Atlantic, I strongly encourage you to give us the opportunity to earn your business. I think it's easy to see why we're excited about Global Atlantic, their unique value proposition, and their products. This is just part of the reason why they are the fastest growing company in the industry today. So you really need to take a look and see how these solutions can help your clients. Our sales team at INA will be following up within the next day. But if you have clients in mind right now that you want to see a proposal for, please don't wait. Give us a call. We'll help you put a proposal together, get these materials in your hands, and everything you need to present these solutions. Our number at Insurance Network America, again, is 800-456-7999. And again, I want to thank you for participating today. Have a good rest of the day. And I want to thank our partner, special guest, Kyle Veenstra. Thank you again, Kyle. And everyone have a terrific Wednesday. Thank you.
Thanks, Tom. Have a great day. Thank you, everyone.
You too.